You could envision a scenario where there's less demand for our Treasury debt, and
Hmm.
therefore, what happens in a supply and demand scenario there, the rates have to go up to attract the people to
Hmm.
buy. And that informs the rate environment more broadly. So then think of that as a tax that we all have to pay with higher rates, mortgage rates, auto rates, dot, dot, dot. And then the Federal Reserve doesn't have the ability in that scenario to make sound decisions with rates.
Hi, Adam Gower here, founder of GowerCrowd.com and host of this podcast and YouTube series, Real Estate Market Watch, current events through a real estate lens. My guest today is Mark Hamrick, who is Senior Economic Analyst and Washington Bureau Chief at Bankrate.com, where he provides detailed analysis of the economy and financial markets. Mark is a long-time journalist with decades of experience. He's been past president of the National Press Club and is one of the few journalists to regularly attend Federal Reserve news conferences. Our conversation covers just about every aspect of the economy and what's going on that would impact the commercial real estate industry. Mark is active on LinkedIn and regularly posts his research findings, articles, and thoughts and analysis on that platform. So if you want to learn more than you hear on today's podcast, just go ahead and connect with him there on LinkedIn. And I'll provide a link to his profile on the podcast page or the show notes page for today's episode at gowercrowd.com. While you're there, if you've not already done so, do subscribe to my newsletter. Comes out as often as I'm recording these podcasts actually these days. And of course, you can always unsubscribe, but you'll get detailed breakdowns of these conversations, my conversation with Mark and with other guests there at gowercrowd.com in the newsletter. Okay, let's move on. Mark Hamrick, who is Washington Bureau Chief and Senior Economic Analyst at Bankrate, coming up right now. Mark, good to see you again. Thanks so much for joining me this morning. All right, so where are we? So inevitably, we're going to roll into stuff that is immediate and time restrained. So it's August the 19th. In preparing or just chatting a little bit now, you brought up an interesting point. You talked about how the big things that are going on in the economy can be masked by the what just happened things, right? In terms of the news cycle. So let's just start with that. It's an interesting insight. What exactly are you talking about in those regards? And what are the big things that are masking the suddenly happened things or recently?
Yeah, good to see you, Adam. And it's always a thought-provoking conversation to be able to join with you. And so I'm getting the brain cells energized. So I appreciate the opportunity. My wife would say I need all the help I can get, but that's another issue. I think the danger is that we can sometimes be so caught up in the moment, acknowledging the volatility and the uncertainty, which is probably a word that could be taxed and resolve the budget deficit in a moment. Uh, that we can sometimes, miss the forest for the trees, as that cliche goes. And I don't necessarily have a solid example to offer you, although I may stumble upon one. But you know, I'm constantly looking at the upper right-hand corner of my computer and saying, "Holy cow, it's that date already?" Do I have to start thinking about midterm elections in the United States, which will be just a year away in November and halfway through a presidential term approaching January? And the answer is yes. And the same holds true for now more than 5 years since the pandemic began. And that was just such an earth-shattering moment that delivered so many changes, including the topic that's near and dear to your heart and those of our viewers, obviously commercial real estate. And so what things happened immediately and what things are still in process. And then thinking about the broader economy, we're very U.S. centric, but our concerns and interests don't end at our borders. Where the U.S. economy has proven remarkably resilient. That resiliency has been tested in 2025 and will continue to be. And it is still the envy of the world in terms of the performance of the economy, financial markets, and obviously the immense amount of wealth that has been created. One example of a structural change, which has been in place for many years, and I would say has been accelerated lately on that latter subject, and that is the division of wealth and the hollowing out of the middle class in America, and that presents itself a million different ways. Where I'll give a concrete example would be going to the airport, seeing the people who are sitting next to the gate versus the people who are in the airline lounge, going to the stadium where the people are in the fancy suites being catered to at levels of luxury that people in the stands below don't feel. Then a more palpable and dramatic representation of that is the division we have in our politics in the United States, which is somewhat informed by this wealth inequality and income inequality, the holding of assets inequality, the difference between those who have a 401k investment in the roaring stock market and, oh, by the way, are fortunate enough to own a home that has acquired some building of equity over the years. So just to try to elevate that in the minds of people to think, yeah, what we're experiencing right now could be incredibly important and determine whether we live to fight another day and the next day, week, month, and so on. But past is also prologue, and we shouldn't forget that.
Okay, so let's you covered a lot. It was a very broad sweep.
Yeah.
So let's drill down on one thing that you've been talking about recently. You've been talking about this idea of wealth transfer. So the middle class has been hollowed out. But the middle class is, and I'm going to make a huge assumption here, is probably these households, I would imagine, in their 30s and 40s today. They're hollowed out, but they also are beneficiaries of the inevitability of inheritance of $84 trillion of wealth from their baby boomer parents, the generation before. So what is the what are you seeing in terms of that wealth transfer, and what's the impact going to be on the economy, and will it help fill out the middle class, do you think?
Yeah, it's a great question. And that's a great example of something that is structural, right? Because we're talking about demographic changes, some of which are consistent throughout the so-called Western world and even beyond the Western world, in the sense of the birth rate declining and insufficient to essentially fund some of our commitments, with Social Security being an example, in the United States. And so, first of all, that wealth divide is merely perpetuated by the transfer, right? Because while you may have younger cohorts who are either sort of on the fence of are they able to afford a home purchase or not, and no doubt for most of those, that process has been delayed to a latter part of their lives compared to, let's say, their parents, perhaps their grandparents. But I tend to think more about post-World War II America. In that when we had the sort of great building out of the American suburbs to deliver value and opportunity. So I would just say that simply perpetuates that, because you're talking about transferring assets from those who hold assets to some who may have some or not as much as they would like. So I think it's obviously very consequential. That among all the many changes that will be occurring in the coming years will be transformative, and you'll have in the process also this housing stock, which seems to be in such short supply on the residential side, also an opportunity to be transferred as well.
Yes, so let's talk about that, actually, the housing stock. And of course, you are a senior economic analyst at Bankrate. So bank rates and mortgage rates are extremely important. And what we're seeing is this locked up effect, right? Or locked in effect, where homeowners won't sell because they have sub 3% rates and don't want to buy at 7% rates, basically. So what's going on there? Unpack what exactly you're seeing in that situation there.
Yeah, and that's a great setup in the sense that this so-called lock-in effect is one which provides a disincentive to move. And in not moving, the supply that is currently occupied, literally, by people like me, frankly, meaning more senior cohorts, older folks, and younger, obviously, meaning younger than me, are just simply not moving. And in another time, we would have had people moving, we would have had greater mobility broadly in the sense of think about we're having the same thing happen with this so-called no hire, no fire job market right now, where, it's stable, unemployment rate's still low, but payroll growth, meaning number of jobs added on a monthly basis, has slowed considerably, just not so much as to damage the unemployment rate or to elevate it. And so the same is true with the supply of homes available. And if anybody had read a comic book about economics, the first lesson in that comic book is about the laws of supply and demand. And so we are seeing to some degree, I'm thinking about the fact that it's affecting both, right? Because if I'm not ready to move, I'm also not going to enter the market to buy a home. But I think the most pressing dynamic is the lack of inventory or lack of supply of homes for sale. And as we know, in the residential market, builders have been trying to address that because they have incentives and other tools that can help to meet prospective buyers or actual buyers where they need to be, where this affordability challenge is a mighty one, both from the continuous rise on a national basis in home prices, as well as, although we've seen some recent modest reduction in mortgage rates, still elevated mortgage rates when you go back to that historical example of the sort of 3% pandemic range to above 6% of late.
So this idea of supply and demand, right? Back to our comic book. I think my economics teacher at the high school would not like me to think of economics through a comic book. What was it? We have almost on the tip of my tongue, the book that we did study for economics. But supply and demand. So what we've got is just work through the logic with me on this. You've got a locked-in seller. So there's no supply, or supply is restricted because people are not selling. So that's what's frozen up. But if, let's just say interest rates did come down, that released it, and I was talking to, I was talking to somebody at another analyst who said that their view was that 5.5% is kind of the rate. I'd be interested to know what your view is, actually. Or what is the rate that unlocks the market? His view was 5.5. Do chip in and let me know what your thoughts are. But if it does unlock, doesn't that immediately, isn't there by definition balance in supply and demand? Okay, it released all this supply, but now all those people are out buying. So does it really have any effect on what's going on in the market, like in terms of house prices in that context?
Yeah. So, I think about that like analogous to a murder investigation, right? In other words, what's the end effect? The body is cold. What is it that caused that change in condition? Okay. So if we got to a 5.5% mortgage rate, what changes? Could it be a recession? Could it be maybe something along the lines of, as broadly thought of, more of a normalization of the U.S. economy beyond the pandemic impacts, which we've actually been in process, in the sense of we've seen many of the impacts of the pandemic sort of, I don't want to say evaporate, but have been reduced. But if it is a recession, then you have other problems in the sense of buyers aren't as well qualified or as inclined. You probably would have some constraint with credit, depending on the severity. But if it's a normalization where we still have, employment trends that are favorable, we can pray for a reduction in inflation because it may take divine intervention for that to occur. Then I don't know that I love the analogy of the lock or unlock because that suggests either sort of open or closed, whereas I would tend to think that just broadly speaking, beyond a certain point, and let's just arbitrarily call it below 6.25%, there's going to be
Mhm.
incremental improvement in the sense of affordability and just sort of the taste to buy a home, as well
Mhm.
as the qualification. But if you want to think about sort of the promised land of where that destination
Mhm.
might be substantially advantageous, sure, why not? 5.5 would be a much better place than 7, 6.75, 6.5. And, we would go to our Bankrate mortgage calculators to tell you what exactly the difference would be for, let's say, a $450,000 home, which is sort of the median price. But but I think it really matters. Back to that crime scene investigation, it really is important how you get to that. And that's why we have, for example, one Federal Reserve official talking about essentially good rate cuts, meaning you're cutting rates not because of a recession, but because you think the economy can continue to proceed at sort of a nominal level with a reduction in restriction.
Do you think if rates do come down, that prices will go up,
If
and then therefore affordability will be further impacted?
I wouldn't worry as much about that myself because I
Mm.
think you would see some of this solution in the sense of inventory being freed up. I mean,
Mm.
if there's been one constant on a national basis in recent memory, meaning the last half decade or so, when we think about coming out of the great financial crisis, which was had housing as the epicenter. Um,
Hmm.
as we sort of resolve all of that, if there's been one constant, it's been frankly on a national basis because we know that all real estate is local when we're talking about the residential market in particular, or at
Hmm.
least in this case. Um, it is that home prices have remained firm, and I've often said that for better and for worse, home ownership in the United States is the primary path toward wealth creation, and that's great for homeowners,
Yeah.
not great for those who don't own homes.
Right. It's this idea of rent. I've done some calcs. It is way more economically prudent to rent. I mean, there's all kinds of side effects and negative side effects that the rent goes up, you can be kicked out. I mean, there's different factors, but from an economic perspective, do you think renting is smarter than buying, and that we've created a renter class like we've never had before in the US?
I would say that for many people, renting is a good solution, and I always like to say, as we
Mm.
let's say talk about our bank rate surveys that sort of outline the challenges to housing or home affordability, there is no shame in renting. That there is kind of an imputed shame in renting in the United States, which is unfortunate to the extent that the sort of
Mm.
bragging that goes on when people have their quiet conversations about what Zillow told them about the home that they own, which I think those are better left quiet than loud.
That's right.
And I say as a kind of correlation to that, I have a 33-year-old son who's a great blessing to our family, who's has a great career in Southern California, and he has a 9-year-old car. He's going against the stereotype in Southern California of driving a flashy car because he doesn't want to have another car payment, right? And
Mm.
we've talked about, that contrary to the notion that we might have held over many years, that this might be among the better times to look at leasing a car, which I would have never
Mm.
said, 5 or 10 years ago. And so
Mm.
there's something to be said about um, there's something to be said about renting when you're accomplishing other financial goals, and that's important.
Ah.
to boost your emergency savings, continuing to save for a home purchase if that's part of your game plan. Because what happens the moment you own that home? The clock is ticking until you have to have a substantial repair, or there's a desire to have a renovation down the line. And oh, by the way, life happens with other costs as well, right? So I think that one of my biggest concerns about home ownership, particularly for younger people, is don't get too far out over your skis with regard to your commitment on sort of your monthly payments, which aren't just the mortgage payment. It's the insurance and the property taxes and the inevitable maintenance costs that come along with that virtual privilege of home ownership.
Mm. Let's pivot something to a different topic. One of these big subjects that you said might be masking the little ones, and in this case, not the little ones, but the news being masked by the news cycle. We get distracted a lot these days, and it's easy to be distracted, right? So I'm going to ask you a kind of a daft question, but deliberately, and that is the idea you've talked about the employment data and the importance of maintaining, presumably accuracy and reliability, and also regularity, monthly data. But why does it really matter? At the end of the day, if real estate is a local business, does it really matter that we have accurate national data? And if so, why?
Yes. No, this is a subject near and dear to my heart, and it's one that I've spent a lot of time thinking about. And as a resident of the Washington, D.C. area for many years, I'm very well acquainted with the people who do this work. There's another podcast that I just recorded with a former commissioner of the Bureau of Labor Statistics, who was a predecessor to the official who was fired by the president because he got some data he didn't like. And ultimately, the performance of the U.S. economy, which is obviously comprised of microeconomies throughout communities or regions, states, or even census districts, is dependent on the performance of those economies as well. And how do we make sound decisions, either as company leaders, as elected officials, as central bankers, as members of households, ultimately consumers, if we don't know what's happening, nationally as well as locally? And the federal government, by the way, delivers data that is more localized as well. So there are subsets of that data that are analyzed, and so is the employment data, for example. For every metro in the United States, for every state, we see that data. And so the simplest way to answer it, or most basic way to answer it, is the path toward good decision making, both personally, for enterprises, for the nation, for states, is lined by high quality economic data, most of which is generated by the federal government. And a dirty little secret about the funding of our statistical agencies is that the private sector, where you have experts who are in close contact with the civilian workers who are dedicated to generating this credible and trustworthy data, have been echoing the call for many years that these agencies are underfunded. And I think about the notion that one of the most unpopular things to fund in the federal government is, ironically, the Internal Revenue Service, which is essentially the equivalent of the sales department of a business dedicated to collecting revenue. If you cannot collect revenue and enforce your tax law, you're dead in the water. And so these things are unpopular. But if I'm heartened by anything, Adam, it is that since this official was let go, there's been a loud bipartisan chorus that has said, essentially, wait a minute. If we don't have credible and trustworthy economic data in the United States, then we're going to fall into the category of countries that are essentially regarded as third-rate countries, where there is no visibility, and that the data matches the aspirations, rhetoric, and lack of adherence to truth that their authoritarian leaders want them to echo. And so that's not a class that we want to be in. We want to continue to be in the world class category. And just to affirm that, not too long ago, Federal Reserve Chairman Jerome Powell was asked about this. He's been asked about it at a couple of news conferences now, which I get to attend. I'm fortunate in that regard. And he said, the US does have world-class economic data. We want it to stay that way, but right now we do have the tools we need. And so any damage to that would be quite significant.
All right, well, so let's talk about that, actually, Mark, if you don't mind.
Sure.
So, take away this, somewhat emotive idea that it's we're comparing lack of data and control to authoritarian states. All right, so so you can have an opinion about what's authoritarian and what's not. Let's just focus on You focus on the data itself. So, what happens if there is if and particularly this employment data that's top of news at the moment? What happens? What is the damage actually that can happen if that data is deemed unreliable? Look, we're not a third world country. We're the most powerful, most economically powerful, militarily powerful, and financially powerful country in the world, or on the planet. So so what? Right? I'm taking a contrarian perspective. Wearing the flag. Wearing the flag. Hey, actually, before you answer that question, what does the blue flag mean? Do you know what that is? The one with the blue stripe through it, the American flag?
I'm not sure what we're talking
What that is. All right, forget it then.
Okay.
It's like a personal thing that came out later.
Okay.
So back to this idea. What is like? We're not a third world country, the most powerful. So what does it matter if we control the narrative by manipulating the data?
Well, let me back into that a little bit, first of all, and to say that most observers and I'm talking about people who are very knowledgeable about the process, say that it would be very, very difficult for, let's say, an ill-meaning individual or even an entire administration to change the process because it's so involved in the sense of many people have their hands on the data. It would not be able to happen without us knowing about it, because this would be heavily leaked through the news media, and it would not be a secret. So first of all, we do have that to lean back on. But the question of what would happen or how would it matter? Imagine that you're running a bank, Adam. Let's say it's a large bank. It doesn't need to be a large bank, but and you're the CEO, and you're having a meeting with your senior managers in that bank, and essentially you're trying to assess how you go about implementing your business strategy for the next month, 6 months, year. Yet you have no confidence in the sense of verifiable and trustworthy data with respect to the course of the U.S. economy. And so at that point, it's a little like giving a pilot an airplane to fly with no autopilot, with blinders on. And the risk is that essentially you crash your enterprise because you just simply are not making sound decisions. And then that filters on down to the household level, because you don't know how many people have actually lost their jobs. You don't know what the rate of hiring is. So not only do you not have data upon which to have a sense of job security or not, but you have the added burden of knowing that you are flying blind, and so are all the major decision makers in the U.S. economy. And we think about the fact that the U.S. economy is powered by the consumer, and consumer sentiment bounces up and down, but actual spending is something different, and that can be informed by sentiment, but it's also informed by the performance of the economy and how our own personal finances may be faring at any given time. And we can judge how our own finances might be powering through or not at a moment. But if we don't have a sense about what's actually going on in the broader economy, that is the kind of thing that would undermine confidence. And if you have confidence that's significantly undermined, then the economy is going to suffer under that weight. And I would just add one more thing, in that the president has done a disservice in the sense of Ray and others, who have sort of parroted his rhetoric, done a disservice to the great work that civilian employees of the federal government have done over these many years, but also raising essentially false accusations about its trustworthiness, because we know that in this polarized society, we basically have people who effectively are all too often willing to chime in to repeat rhetoric of the team they're cheering for, and that's true of both the Democratic and Republican teams, and it's our job as truth tellers to say, wait a minute, there wasn't corporate price gouging as accused by the Biden administration as a primary cause of inflation, and in this case, trying to hold truth to power. The data, which has been reported, has had some challenges because of under participation in surveys by businesses.
Responses.
That's another issue, and that's something that can be addressed. But just to sort of throw that proverbial baby out with the bathwater and say, it's essentially fake news is. We haven't heard a conversation at the highest levels about let's improve the data, right? We've not heard that conversation, which is the conversation that actually needs to be had. It's been, don't watch this shiny thing over here. It's watch this shiny thing over here instead. And we actually need to watch the other shiny thing.
Well, of course, the irony to having good jobs data is that it incentivizes presumably rate cuts. And so it's a little confusing, but let's just get back to this. I really do want to explore the idea of damage to the economy, okay, and what exactly happens. So you've described this issue that without good national data, it makes it difficult to make business decisions. It makes it difficult to I mean, all predictions are difficult, but you do rely on data to understand what trends are happening and to make decisions about going forwards in terms of banking and the debt you take on and what you invest in, etc. But there are other factors as well, aren't there? So if there is a lack of confidence or a decline in the confidence of the data coming out of the US government, right? Can you connect dots for me to interest rates and inflationary pressures? Can you try and do that for me? Because at the beginning of my sentence that I've got typed out here to ask you this question is I think of bond and more recently stock vigilantes and the pressure on the Fed, and we can get to that in a second. But inevitably, it will have impact on interest rates, won't it? Because of demand for bonds and trust in institutions, etc. Can you explore that idea a little?
Well, I mean, you begin with the fact that, the U.S. is financing its debt, right, through Treasury bonds, and by the way, continuing to build that debt at hyper speed with the passage of the continuation of the 2017 tax cut, as well as some add-ons there. And so, there has been this discussion, which I think has been more of a worst case scenario discussion than it has been something that's actually been occurring, and that is that at a significant level, and that is, we are dependent upon essentially the globe to finance the U.S. debt through the sale of treasuries. And so if this market is no longer seen as credible under a scenario which, by the way, we don't currently fully envision, meaning, as I said earlier, we believe the data is still credible. It's that we've had this injection of doubt thrown at it from the highest levels of our elected government and the chorus of those that support it. So, we need the U.S. marketplace to be seen as credible, and part of the underpinning of that is credible data and knowledge about how the performance of the economy is faring. And just, for example, think about the Federal Reserve, which is the determiner of short-term interest rates in our country with the benchmark federal funds rate. What's the dual mandate that the Fed is beholden by law to focus on? It is, on the one hand, maximum employment, meaning a stable and well-performing job market, counterbalanced by stable prices, meaning trying to keep inflation in check. And the Fed's definition of that is an annualized increase in prices of about 2%. Well, if the primary sources of information that come from the federal government, in this case, essentially a set of three different data sets on inflation, consumer price index, producer price index, personal consumption expenditures price index, are to be undermined or were to be undermined, and then the employment data is undermined, the Fed is saying, okay, where else can we get data that is credible? And right now, my mind isn't clear enough to figure out what that path would look like, because frankly, it seems like a remote possibility. But there are some correlations to, as someone who, like everybody else in the world, well, except for those who are experts, trying to figure out like how the global economy is performing. And every now and then there'll be a headline, let's say on a quarterly basis or whatever the updates might be, on how China is performing. And there's always been a kind of an asterisk attached to that data. In this case, it's one that's in our mind, but it's an asterisk that says the actual truth may vary with respect to the performance of the Chinese economy. Why? Because it's not a democracy. It is an authoritarian regime that doesn't have the same kind of fact-checking or even fact-producing incentive that we have in the United States. And so, that's an extreme, right? And the positive news is that the U.S. has been on the other end of the extreme. So if to boil it back down to the crux of your question, you could envision a scenario where there's less demand for our Treasury debt, and therefore, what happens in a supply and demand scenario there? The rates have to go up to attract the people to buy, and that informs the rate environment more broadly. So then think of that as a tax that we all have to pay with higher rates, mortgage rates, auto rates, ... And then the Federal Reserve doesn't have the ability in that scenario to make sound decisions with rates, which means we go back to a model. Well, let me say we go back to a comparison that Chairman Powell has made, and essentially everyone else who's occupied that role that I've followed closely for the last, let's say, nearly 30 years, and that is politically independent central banks have a historical track record of performing their jobs better than those which are essentially, being held by the collar by the head of government or either an elected official or a prime minister, effectively, or one who isn't elected. And so we need for them to be able to do their jobs to the best of their ability, and they'd be the first to admit that they're far from perfect. Or maybe not the first, but they'd be among those to say that.
All right. So so this, what I was getting at there was this idea that, okay, the idea of predictability of the national economy it's a kind of a harder thing to understand.
Yeah.
But if inflation kicks in or interest rates go up, that's something that everybody understands immediately, because it has immediate impact. It's extremely visible on everything that we do, right? Just on a day-to-day basis. So that was kind of where I was getting at. The impact of a loss of confidence in the quality of the data could have direct effect on interest rates, right? Because if foreign buyers stop buying, investing in bonds, they want higher yields. And so that has this counter effect in terms of
Yes.
interest rates.
Yes.
All
Yes.
right. Go ahead. You were going to say
No, I
something.
was just going to say, you and I are of a certain age where we are knowledgeable about what happened in the United States during a time of high inflation, about a half century ago. And yet younger people, no fault of their own, had not experienced that, right? And so, given the fact that the Fed didn't hit its 2% inflation target for many years before the pandemic, the idea of inflation in the United States was, at least in terms of the data that we measure, on the broad brushstrokes, as opposed to, let's say, sector-specific inflation, cost of higher education, medical care, dot, dot, dot. All that was very much a remote idea. And so it's unfortunate, but it's useful that this younger generation has been brought up to speed on what inflation looks like. And they're obviously hoping, along with the rest of us, that we don't see that further exacerbated.
The negative impact of data manipulation, if that is the topic that we're talking about, or lack of confidence in data, and the impact on society in terms of inflation, in terms of interest rates, or something, or the equivalent. Is this a clear and present danger? Is this something that's going to happen? What are we? August? Is this before the end of the year? Before the midterms, or is the impact only going to be felt once this administration is outtermed and we're now, years from now? Is this a long-term thing or short-term?
Well, I think I need to be clear on this. The issue has been raised because essentially the head statistician for the Labor Department was fired. Mm-hmm. And that person was fired because the president didn't like the data, which was negative, meaning that we had downward payrolls revisions that really changed the way that the job market looks as we sit here in mid-August and know that we'll have another set of data coming up, and that will include revisions as they always do. We don't know what it will include, meaning what directionally and statistically the revisions will be. But the pressure is on the administration and essentially our government as a whole to continue to deliver this credible economic data we've been talking about. And the risk is that, as we've been talking about in so many different iterations in our country, where we have, many different changes that have occurred because of this presidency and his priorities, that we can imagine things stay largely the same, but we can also imagine scenarios where they go wildly off track. And I don't think it's prudent for me to make a firm prediction to say the data will not be credible 6 months from now. I don't have a reason to believe that will be the case as we speak. But it is the risk, because we've seen it in other iterations in the government where the need to present a narrative, which may or may not be based on fact, takes a priority over the actual facts. And so what I would just say is that for everybody who's listening to this, watching it, pay attention. Continue to pay attention, because this subject isn't going to go away, because, for example, as we speak, the person who's been nominated to have that job has held some extreme positions, including getting rid of the central bank in the United States with nothing to replace it. Another suggestion has been simply to not produce or report the data monthly at all, right? Those are extreme, wild ideas that would have never come up in another setting. I think that we can hope, and I think there's a reasonable chance that there is a point at which even Republican members of Congress would raise their hands and say, wait a minute, I know sometimes that those boundaries have not always been respected in that sense. But as I said a few minutes ago, one of the things I've been heartened by is the bipartisan outcry, including, from members of former Republican administrations who said this data could use some help meaning, it needs some additional resources, maybe some fine tuning on the process, but at its core, it is trustworthy. And so I would just simply say, I'm not setting off alarm bells to say we have a reason to believe the data isn't going to be credible next month, 6 months from now, but something happened that is different, meaning this firing, and a nominee who I think could be widely seen as not sufficiently qualified has been at least thrown out there, and we'll see what happens in the confirmation process.
May you live in interesting times, they used to say. I always thought that was a really, a nice idea, but apparently it was a curse. You live in interesting times. All right, so we should start wrapping up. Actually, it's incredible how fast our conversation has gone, Mark. But we've not even talked about this idea that you've shared, this new lease of life to inflation that tariffs have brought. We've focused on on other topics, but what are the economic stories at the moment, or economic factors, again, in this context of distraction, small distractive news cycle over preventing us from seeing the bigger pictures? What do you think is being underreported at the moment as we start to wrap up?
That's a good question, because then you have to sort of ask, well, what is being reported? What may not be sufficiently appreciated or sufficiently amplified? There are some challenges in the sense of we don't have the level of financial literacy in our country that we need to have, and that's a structural issue. In other words, a long-term issue as opposed to a short-term one, but it does have impacts on the short term because people don't necessarily have the financial skills, leaving aside the resources to accomplish their financial goals. How do we have bad outcomes? Well, bad outcomes are arrived at because lack of sufficient knowledge, right? So that is one thing that's a structural issue that concerns me, and it's parallel on the financial literacy piece to lack of civic literacy. Knowledge about how government should work. Oh, there are 3 branches of the federal government that were empowered by our founders for good reason. So civic literacy parallel to that. Health literacy. What are actually the foundations of trying to achieve good outcomes with health in our country? News literacy being undermined by disinformation and the ability for anyone, including those who have nefarious goals, to distribute information that is untrue or at least not credible. So those are very broad brushstrokes, but when we look at our Bankrate data where we're surveying consumers, essentially everyday Americans, we still have these underlying challenges that Americans are trying to solve for that include lack of sufficient emergency savings, that a good number of Americans don't think that they'll have sufficient retirement savings, and all this happening while we have less reason to believe that under the current structure, Social Security will be able to deliver its promised benefits in under a decade. And of course, as time goes by, elected officials have only done more to undermine that problem or to build the problem more rather than to solve it. So I guess if I had sort of my magic wand to wave, I would deliver higher levels of financial literacy for our country and even our world to help our elected officials deliver better solutions for those people. And then in so doing, hope that they can more easily or more efficiently, more effectively arrive at the destinations that they want, which ultimately is just sort of living their best lives. And unfortunately or fortunately, money plays a big role in that.
Yeah, and unfortunately, the problem with over-educating the population is it tends to, influence how they vote, and that can be really inconvenient as well, right? All right, so last question, Mark, for you today. So, what indicators are you watching for that informs you kind of about the direction of the economy? What are the key indicators that you watch?
Yeah, that's a great question, and so I do have a checklist, and I'm constantly updating it and maintaining my records on that, and so in the sense that we're U.S. centric at Bankrate, we're talking about U.S. economic indicators. I would go back to the Federal Reserve's dual mandate because that really is at the heart of the performance of the U.S. economy, which matters to all of us, and so the strength of the job market and inflation. And so the monthly employment data, we just talked about how important that is. We have weekly data on the health of the job market, which is new and continuing applications for unemployment insurance. That's kind of closer to real time. We watched that very closely during the onset of the pandemic because the job market was falling apart. Not surprisingly, because much of the economy was locked down. The main the main inflation indicators are the consumer price index, the producer price index, the Federal Reserve's preferred inflation gauge, which is personal consumption expenditures, price indices, which, by the way, recently have been running closer to 3% than the Fed's 2% target. And then obviously important for the core of your audience, the performance of the housing market. Let's remember Bankrate is built on 50 years of history of collecting interest rate survey data across all the markets where interest rates come into play, savings and lending. And so we watch mortgage rates very closely at Bankrate with our survey of large lenders issued weekly. So obviously the performance of the housing market being measured in existing home sales, new home sales, builder confidence, housing starts. Though, and retail sales, the performance of the consumer, how well is the consumer spending of late? And we know that in this tariffs environment where both headwinds are created with economic growth as well as with tension with higher prices, which may continue to be an issue for as long as tariffs are the key tool in this administration's toolbox. We'll be watching all of that, and the effective tariff rate, which we would have never have brought up, decades ago, is something that now at the highest levels since the Great Depression is something we're monitoring as well.
Oh my goodness! Like the last few words that you uttered were about the Great Depression. Isn't that extraordinary to even imagine that we might be even comparing what's going on today with something like that? Mark Hamrick, Washington Bureau Chief, Senior Economic Analyst at Bankrate. Thank you so much for joining me again today.
My great pleasure for this very engaging conversation. Thank you for having me, Adam.
All right, that was Mark Hamrick, Senior Economic Analyst and Washington Bureau Chief at Bankrate.com. Mark, what a pleasure to speak to you again. I really enjoyed our conversation. I enjoyed our little chat before, and particularly our little chat afterwards as well. Thanks so much for spending your time with me today. And thank you too, dear viewers and listeners. I'm glad that you were able to join us, that you've listened all the way through to this point. And of course, if you've not already done so, do subscribe to my newsletter. It comes out relatively regularly. I've been producing it when I have a podcast, so it's not coming out exactly every week or on the same day, but news is so it's changing. The news cycle is changing so frequently that I figured we'd record these podcasts and get them out as fast as possible. And so that's exactly when I'm producing the newsletter as well. So go ahead and subscribe there at gowercrowd.com. All right, that is it for this week's show. And until next time, this is Adam Gower signing off.